Hello everyone, welcome to a new episode of Investing Fool. Please read the disclaimer before we move on to the video. In today's video, hopefully it will be a short one. We'll just discuss about this time's rebalancing and some general observations. We did the rebalancing on Tuesday, so Monday was 30th. So based on the prices and based on the rankings at the end of session on 30th, we did the rebalancing on first. I had shared a post about this on Tuesday, but I was unable to make the video. So I'm creating the video today. So let's just quickly go through the changes. As has been discussed previously, we won't be talking about specific stocks or anything, but the overall patterns. So the core momentum portfolio currently is at 19 to 20%, around 19 to 20% drawdown. And this is something that as momentum investors we need to be very used to. As I had said in the previous video as well, that every couple of years you need to be prepared for around a 25 to 30% drawdown, right? And so almost all momentum portfolios today are weathering this. And if we look at some of the indices, so the core momentum portfolio we have is built on the Nifty 500 or CNX 500 universe, right? So if we look at the Nifty created index on the Nifty 500 universe comprising of 50 stocks, which is the Nifty 500 Momentum 50, that is also currently at a drawdown of 15%. So no one is spared. It's pretty known that like when things go rough, then momentum portfolios fall very hard, and when things are going right, then they perform above average usually, right? So that's where we are. So if your momentum portfolio is also in a drawdown, and remember that this core portfolio had gone to a max drawdown of around 34%, right? After this rise, like from April, after this rise, it has come back to around 19% drawdown. So we are still so below our all-time high, right? It will take a long time unless there is a fierce rally or anything, which I don't expect. So it will take a long time to get to a new all-time high. Anyway, regarding the rebalancing, there were 3 exits this time. So most of you who have been following the portfolio, and for anyone who is watching this video new, we do not discuss stock names, but you can look at the stock names if you want by clicking on the link which is added in all the video descriptions, the core momentum portfolio link. So talking about this fortnight's rebalancing, which is the end of June rebalancing, there were 3 exits, one large cap, one mid cap, one small cap left the portfolio, and subsequently 3 new entries, 2 large cap and 1 small cap. So currently there are 22 stocks. We had started with 20 and I'm gradually going up to 25. So whenever there is any large exit, because I'm not adding any new capital or taking off any capital from the portfolio, for this purpose, at least my personal portfolio, I will be adding capital, of course. But so because of that, so the stock number has gradually increased from 20 to 22, and with further large exits, if they ever happen, I will take it gradually to 25 stocks total, a total of 25 stocks. That is where we will stop. In terms of the sectors, you can see on the right side, this is the current composition of the portfolio. So financial services is the largest sector, and this is a general fact across all momentum portfolios. In fact, I wanted to discuss about the recent rejig in the momentum indices as well, right? So there are a lot of financial services stocks that came in the Nifty 200 momentum 30, Nifty 500 momentum 50. All these indices got rejigged on, I think it went into effect on June 27. So these are rebalanced semi-annually, right? So once in June, once in December. So the June rebalancing happened just recently. Maybe we'll do a separate video about that. But there also the trend was very similar, that financial services are taking sort of a center stage. They're doing well price wise, and that's why you can see them being reflected on the momentum portfolios. The healthcare sector has been there for long actually. There have been many stocks, and this has been there from almost the end of last year. Healthcare stocks have been there in the portfolio with a significant allocation. The one surprise is defense. So defense had like, if you have been following our portfolio for a long time, we made good gains on some defense stocks last year. There were some that were lossy as well, but all of them we had exited, right? As and when they started falling, all of them we had exited. And recently defense stocks have started coming back. So currently like there were two defense stocks earlier, and with this rebalancing, one defense stock has been added. So currently there are three defense stocks in the portfolio. And when I talk about the exits, so before April, right? So when the crux of the fall was there in Jan, Feb, around March, we saw that most stocks were getting out or getting chopped off, exiting the portfolio, because they had fallen 25% from their all-time high. And that is because they had so much scope to fall, right? Every stock was almost at a new all-time high, like around September last year. And then selectively stocks started like losing positions from their all-time high, and started sliding downwards. So a lot of stocks, almost all of the stocks actually, if you look at the exits tab here, if you look at the exits tab here, you would see that almost all the stocks are due to, just ignore the stock names, but what I'm trying to say is that you can see all these like falls, right? The falls are because of 25% fall from all-time high. But you see, like from April onwards, right? From here, we are like almost all the stocks that are exiting are because like their rank has basically exceeded the worst rank held criterion, which is 50 for us, right? So because their rank has gone below 50, that's why they're exiting. There are no stocks almost which are like falling 25% from their all-time high anymore, and that is kind of expected. This is a consistent trend. And this time we had two winners and one loser, and the average gain on the winners was also higher than the gain on the losing stock. So because stocks have fallen so much, because there has been a consolidation for some time, because the earnings for 2 quarters have remained subdued, and there has been some consolidation. It's not that there has been any massive correction, but because of that factor, most of these exits are because of worst rank held criterion. One thing that we need to remember is that there are always stocks, like if you have been following a momentum portfolio, you will see stocks that are making new highs. Those will be in your portfolio. But and consistently, like there will always be, the market is not in a rip roaring rally currently, right? It is like consolidating for some time, then going up, then again consolidating. So stocks will keep going up and down. There are not like heavy deviations in rankings very quickly, which is a good thing. I do not personally want a lot of churn in my portfolio, so I do not want ranks to go wild like here and there. And because of all this, like stocks will gradually build their momentum over time, right? So there would be a lot of stocks. See, almost 2/3 of your stocks, or almost 60% of stocks that come in your portfolio will be loser. They either won't do anything or go down and they will exit your portfolio. But the remaining ones, they will gradually build some gains. So they will remain at maybe 10% for some time, then they will gradually inch up to the 20s, then 30s. So this will take time. The stocks will also remain in your portfolio for long, but in general, individual stocks and sectors both, like it will take some time to solidify. The market is not in a condition where we can say that okay, like this is definitely in momentum, or like we can be very sure about it, right? The market is still finding its way. We do not know. Most of like the broader indices are still not at their all-time high, and we'll talk about it shortly. Anyway, about the exit metrics, some of the exit metrics that I wanted to quickly discuss is the winner percentage has declined over the last 4 months. So it was around 37% in March. Now it is around 33%. So basically 1/3 of all our stocks or whatever bets we are taking are winning stocks, and 2/3 are losing stocks. But the average gain on the winners is around 26%, and the average loss on the losers is around 12.5%. So this is where the I mean, where you expect that because of this fact, you may outperform your index over a long period of time. Of course, we are not outperforming as of now because of what has happened since early 2025. The average holding period, the average gain on winners and average loss on losers, that has also stagnated over time. So because there have been a lot of at the end of the day it's an average, right? So as the number of values build up, they will slowly like plateau, right, at one level, unless there are any huge deviations. So we are not seeing any huge deviations as of now. No stock is going crazy. So these have stagnated, and the average holding period has also stagnated around 87 days. So from each rebalancing, for each next rebalancing, there is not much change in this value. So basically what this means is that we are on average holding a stock for around 3 months in our portfolio. Okay, let's take a look at the Nifty 500 index. This is the Nifty 500 index. You can see that the maximum drawdown that was there was around 19% for this index. And you can see that here this red circle is where the index went below its 200 DMA. Many people actually use this signal to take cash calls or to not invest any new money in the market. It went down and swiftly it actually came back up. So you can see a clear V-shaped recovery here, although the recovery is not complete, right? So we have still not got to our all-time high. So we are still below the all-time high for the Nifty 500, which is our base index. And this green circle is where it has crossed the 200 DMA again. So if you are using this as a cash call signal, it's probably here that you would want to revert to your original strategy, right? I personally am not doing that, so I have remained invested throughout this entire time, and basically that is where you see the portfolio where it is now. You can see the death cross and the golden cross here. So the 50 DMA is crossing below the 200 DMA here, and it is crossing above the 200 DMA here. But what I wanted to share is compare this with the next chart that I'm going to show. So this is the Nifty 500 chart, right? And this next chart is the Nifty 500 Momentum 50 chart, right? So this is a momentum index by the Nifty only, based on the previous chart that I showed, which is the broader index of Nifty 500. You can look at the amount that this has fallen, right? From the top, it was almost 32%. So we saw 19% there and 32% here. So think how much of gains it will take for a momentum index to get to a new all-time high. And like this chart is shown only until here. This was around November 2024. Before that, these black dots, these are the back-tested values. So you can see the death cross here. The golden cross has still not happened for this index, right? So the index has just crossed the 200 DMA, but like the 50 DMA has not crossed above the 200 DMA till now. And this is something that we should keep in mind all the time, that like if you fall so much, it will take a long time for you to get to a new all-time high, compared to someone who is just like invested in a Nifty or a Nifty 500 broader index, right? But having said that, when the backtested results, when we see the backtested results for any momentum strategy, right, you can check out these things on niftyindices.com for these indices. Even with all these falls, the rises are also significantly higher, right? The falls are very bad, the rises are also good, and that is why over the very long term, like 5 years, 10 years, a momentum portfolio typically outperforms the universe of which it is constructed, right? This has been a phenomenon. You have to believe in this phenomena if you have to invest as a momentum investor, right? One last thing that I would want to show is that I just recently added gold, a gold weightage to the month-on-month returns sheet here. Yeah, so here we can see, as I've all I have talked before, and we can do this in a separate video. I just want to give a brief glimpse. So I have always, like I have said previously in the videos that I think early last year or somewhere I was around 15% gold allocation in my overall portfolio, and the aim was to gradually increase up to 25 and 30%. So I reached 25%, and like a few months ago I had reached almost 30%, and I'm stagnating there. So if I have to take a portfolio of 70% momentum and 30% gold, so you can see that while your momentum part, of your portfolio will experience huge drawdowns and it will take a lot of time to recover, If you are invested 30% in gold, then obviously the drawdown will be mitigated. So rather than taking cash calls, I've said that this is my strategy to sort of so basically to address the drawdown problem via asset allocation rather than taking any cash calls. Because if I come across any really good strategy or filter to take cash calls, right, then I might be tempted to use it. But for now, this is it. And of course, like my portfolio is not exactly like this, because I did not reach my 30% allocation. I have not maintained my 30% allocation from the beginning, right? From the end of 2023, when we started this portfolio, it has been more than 1.5 years. I haven't maintained 30% gold allocation. It's only a few months back that I reached the 30% gold allocation. But if I had done that, you can see the charts here. So the red one is basically our momentum portfolio, which is the core momentum portfolio. The blue one is our broader index, which we are tracking, which is the Nifty 500. All of these are normalized to a score of 100, right? And this, I think, in the daily sheet, I've tracked the values of gold bees basically and normalized all of them, and then taken a 70-30 ratio of the momentum portfolio NAV and the gold bees price, right? So when we mix like momentum 70 and gold 30, which is this yellow line that you see, then you can see that like when the rally was ending, right, around maybe September October last year, then the core momentum portfolio was at the top, right? It was beating the index, everyone was happy, everyone was very jolly, right? And the gold combined gold plus momentum, right, that was even less than the broader index, the Nifty 500, right? Because the broader index was also going up, right? When the fall started, when the correction started, you can see what has happened with the red line, which is the momentum portfolio. It has crashed completely. It has, like, from this much high to the blue line, it has crossed the blue line and gone so much below, and now it is trying to trace back. The blue line also went back and now it is going up. But look at what this gold combined gold momentum combo has done, right? It has fallen less than the blue one. So this point is the minimum of the combined portfolio, right? So it has fallen less than the blue one and the red one, right? So the drawdown is the least. And because the drawdown is least, and obviously this is sort of a hindsight bias, because gold has performed like amazingly in the last couple of years, right? That performance is not replicable. It won't always happen. So imagine if this was a time when gold was not doing anything. So gold, it has historically happened that gold will not do anything for 5 years, 10 years also, right? So if that happens, and I'm talking in USD terms, not in INR terms, because sometimes you would see INR in terms of INR, gold will be appreciating because you have the INR USD depreciation also, right? So if you take in USD terms, it can happen that gold will not do anything for quite some time. So in that case, this may not look as rosy, but I'm just putting it in the context of what had happened if we had like done exactly 30% allocation to gold and rebalance it maybe every couple of months or 6 months. Then we would be here, right? So we fell less and we recovered much quicker. As a result of all that, this NAV is actually more than the blue and the red. Now this can again change, right? If the market goes into a rip-roaring rally again, like everyone is happy, gains are being made on every stock, you can just randomly throw your money on any stock and the gains are being made, then again, like, this will be muted, the returns will be muted to some extent, and the red line might go up, right? So you have to understand the purpose of having gold in your portfolio. You have to understand the likely outcomes, what will gold do to your overall portfolio, right? So if you have something high beta or risky as momentum, you want some kind of a stabilizer like gold to hedge it, or you then you can take other systematic cash calls to kind of protect your downside, because the least your downside is, the quicker you are likely to recover, right, and go at a new all-time high. And personally, like, over the last few months, when the market was in doldrums and everything was going down, having increased that gold allocation to 25 to 30%, I was in that 25 to 30% range. That has personally helped me a lot, right, to weather this. And going forward also, I expect a similar role being played by gold. So that's pretty much it for today. If you like this video, please click the like button, and if you haven't subscribed, then please subscribe to the channel. I'll see you in the next video. Till then, take care. Bye bye.